The defensive interval ratio is a financial metric used to measure a company's ability to cover its short-term liabilities with its most liquid assets. This ratio is particularly useful for assessing a company's financial stability in the short term, especially in comparison to other liquidity ratios, which might focus on different aspects of short-term financial health. The defensive interval ratio provides a clear indication of how long a company's liquid assets can cover its expenses if the company encounters a sudden decrease in revenue or operational disruptions. Defensive interval ratio. The defensive interval ratio measures the number of days a company can sustain its operations using only its liquid assets, such as cash and marketable securities, without any additional cash inflows. This ratio is different from other liquidity ratios, such as the current ratio or quick ratio, which assess the ability to cover short-term liabilities, but do not specify how long the company can sustain itself under financial duress. The defensive interval ratio is particularly useful for understanding how long a company can remain operational without new revenue. To calculate the defensive interval ratio, you need to determine the total amount of liquid assets a company holds and the average daily expenses. The formula involves dividing the total amount of liquid assets by the average daily operating expenses. Liquid assets include cash, cash equivalents, and marketable securities. Average daily operating expenses are calculated by dividing the total operating expenses for a period, usually a year, by 365 days. By performing this division, you get the number of days the company can cover its expenses using only its liquid assets. Example: consider a company with total liquid assets of $1 million and annual operating expenses of $7,300,000. First, calculate the average daily operating expenses. Divide $7,300,000 by 365 days, which equals approximately $20,000. Next, divide the total liquid assets of $1 million by the average daily operating expenses of $20,000. This results in a defensive interval ratio of 50 days. This means that the company can sustain its operations for 50 days using only its liquid assets without any new revenue. Low defensive interval ratio. A low defensive interval ratio indicates that the company has a limited number of days it can sustain its operations solely with its liquid assets. This suggests a higher risk of financial instability, as the company may not have sufficient reserves to cover short-term expenses if it experiences a revenue shortfall. Companies with a low defensive interval ratio may be more vulnerable to operational disruptions or economic downturns. High defensive interval ratio. A high defensive interval ratio signifies that the company has a substantial number of days it can sustain its operations using only its liquid assets. This indicates a stronger financial cushion and lower risk of short-term liquidity issues. A higher ratio suggests that the company is better positioned to handle unexpected expenses or revenue declines, providing a greater margin of safety in financial planning. How can companies optimize the defensive interval ratio? Increase liquid assets. Companies can enhance their defensive interval ratio by increasing their holdings in cash, cash equivalents, or marketable securities. This provides a larger buffer to cover expenses in times of financial stress. Reduce operating expenses. Lowering operating expenses can also improve the defensive interval ratio. Companies can achieve this by optimizing operational efficiencies, negotiating better terms with suppliers, or reducing overhead costs. Improve cash flow management. Enhancing cash flow management practices, such as accelerating receivables or managing payables more effectively, can increase the available liquid assets and thus improve the defensive interval ratio. Key takeaways. The defensive interval ratio is a crucial measure of a company's ability to sustain operations using only its liquid assets. It provides a more precise understanding of short-term financial resilience compared to other liquidity ratios. Provides insight into short-term stability. It reveals how many days a company can operate using its liquid assets alone. A low ratio indicates financial vulnerability. A low defensive interval ratio suggests higher risk and potential difficulty in managing short-term financial challenges. A high ratio shows financial strength. A high defensive interval ratio indicates a strong liquidity position and better ability to handle financial disruptions.